All right, now we're going to take a look at actually calculating out our inventory using whichever assumed cost flow method that the manager has chosen. And so here we're primarily going to look at Fifo and Lifo. Lifo is the most commonly used one for most retail merchandisers. And FIFO is the most commonly used one for raw materials in a manufacturing setting. So those are the two we're going to concentrate on. I do have, if you take a look at this particular PowerPoint without the video, then you will see slides on the average cost system that goes through it. And if you ever have any questions, if you want to know more about the average cost system, certainly I will be glad to help you out. Okay, but for class, we're going to concentrate on FIFO and LIFO. Okay, as we said in the previous video, there are 4 cost flow assumptions: specific identity, FIFO, LIFO, and average cost. And these are how we're assuming the cost flow, which is not necessarily the same as how the actual physical inventory goods flow from the time they get to us to the time they get sold. Okay, the manager can choose any one of these 4 primary systems. Typically, however, FIFO and LIFO, as I said, are the most common, so we're going to zero in on those. The specific identity method, as we said before, is usually if there's high dollar, low volume, and the inventory is highly unique. Each inventory item, each yacht is completely different, and so it has an ability to see exactly how much did it cost us to build this yacht versus that yacht. Okay, here is the data set that we're going to use, and we're going to go through and take a look at calculating out using FIFO and LIFO using this data set. So here on the 1st of November, we had already 3 units sitting in inventory, and they had originally cost us $4 a piece. And then on the 5th of November, we purchased 10 more units, and they cost us $5 a piece. On the 10th of November, we sold 8 units to customers, and of course, we charged the customer more than it cost us, so we charged the customer the sales price of $10 a piece. On the 15th, we purchased 12 more units, and those units cost us $6 a piece. And on the 25th, we sold 9 units to customers, again at $10 each. Now, we want to be able to figure out what is the cost of goods sold and the ending inventory for each cost flow assumption using this data set. Now, remember, we're focusing on perpetual inventory system. That means every time inventory comes in, which is when we purchase it, we're going to be debiting inventory, and every time it goes out, we not only have the regular sale journal entry, but we have that second journal entry where we have to debit cost of goods sold and credit the inventory for our assumed cost. So we have to calculate out the cost right then when we're selling stuff. So here we sold stuff on the 10th and we sold stuff on the 25th. So both of those days, we're going to have to drop what we're doing, calculate out what those cost us so that we can put that second journal entry in. Now, this is a journal entry example, and this came from the previous one. This shows us on November 5th, we're debiting inventory and crediting accounts payable for the $50. So if we go back here, on the 5th, we purchased 10 units at $5 a piece, so 10 times 5 is $50 on the 5th that we purchased. So we're debiting inventory for $50 because that $50 worth of inventory came into the store, and we're crediting accounts payable, and of course we would credit the vendor name as well. We can take the data set and we can calculate. Our first step is to add up the units and calculate out the cost of goods available if you have an entire data set available to you to do this. And since we do, we're going to go ahead and do that. Obviously, in real life, you're not given a data set. Okay? So we had 3 units to begin with. They each cost us $4, and that so that multiplied out is $12. We then purchased 10 more units at $5 a piece, so that was $50, and we purchased 12 units at $6 a piece, so that's $72. So we add up the 12 and the 50 and the 72. We have a total cost of the goods that were available of $134. And we look at the units. We had 3 units to start with, and then we purchased another 10, and we purchased another 12. So altogether, we had 25 units available in the store for customers to choose from. And those 25 units cost us $134. Now, if we take a look at the ones we sold 9 units at one point and 8 units at another point. So that was a total of 17 units that we sold during the month. And so if I subtract the 17 units that were sold from the 25 that were available for sale, then I have 8 units that are left in my ending inventory. Somehow I have to figure out how much of the $134 belongs to the 17 that were sold, and how much of the $134 belongs to the 8 that were in the ending inventory. Because of course I paid $4 for some of them, $5 for some of them, $6 for some of them. And so trying to figure out how much of that 134 goes to which ones, I don't know. And so I have to make an assumption and then calculate it from there. So here in the Fifo method, okay, first in, first out, which means the oldest first ones into the store are the first ones we're assuming are sold, whether they're physically sold or not. And so if I go back to my data set, okay, on the 10th, we sold 8 units at $10 a piece, okay? So I'm going to be debiting cash or accounts receivable and crediting sales for this $80, 8 times 10. But now I also need a second journal entry where I figure out the cost. So I sold 8 units. I'm saying FIFO. That means they came from the oldest units. Well, the oldest units are these 3. So I'm going to use 3 of those. Now I sold 8, I got to account for 8 units. So 3 of them I'm going to use, so I need another 5 more. So I come down to the next oldest purchase, which are these 10. And I'll take the 5 out of those 10 that are $5 a piece. So I'm going to have 3 at $4 a piece and 5 of these at $5 a piece. And that will equal my 8 units. So here's my 3 at 4 and my 5 at 5. I make sure that my units add up to this 8. Make sure of that. If they don't, if you don't add up to the number of units that you sold that day, this is on the 10th, then you messed up. Okay, you need to correct that. Okay, once I got these units situated, then I can multiply across. 3 times 4 is 12, 5 times 5 is 25. I add those up, 12 and 25 is $37 is my cost of goods sold for that day. Now, if we take a look at the journal entry that we do, okay, here's our sales part of the journal entry on November 10th. We're debiting accounts receivable or cash if we receive cash for the $80. And we're crediting sales for the $80. That's the 8 units, and we sold them for $10 a piece to the customer. Okay. Now, I also have to have a second journal entry every time I sell something, and that second journal entry, also dated on the 10th, is going to debit cost of goods sold and credit inventory. And this is for the assumed cost. Okay. So in this case, we came up with $37 is our cost of goods sold for that day. So we would debit cost of goods sold, which is an expense account, and credit inventory, which is an asset account, by that $37. Okay, so in the inventory account itself, on the debit side, the $12 is the beginning balance. Okay, if I go back here, the beginning balance was $12, and then we purchased $50 and we purchased $72. So in our inventory ledger, and of course I have a T account here to make a pictorial representation of the ledger. Okay, here's our $12 we started with, and we purchased 50 and we purchased 72. So the total cost of our goods available, which is our debit footing, is 134. So this is all the inventory that came into the store is the inventory that gets debited. Our beginning balance plus everything that came into the store. Okay. Now on the credit side, we have to put everything, the cost of everything that went out of the store. Now we just saw the journal entry where we're debiting cost of goods sold for the 37 and crediting inventory for the 37. Okay, so then I can immediately see what my balance of inventory is at any given time. All right, so let's take, we sold inventory also on the 25th. We sold 9 units on the 25th. And we sold them to the customer for $10 a piece still, okay? And FIFO says we have to go back to the oldest units, okay? So I need to account for 9 units. What is the cost of 9 units? So these 3, we already used them up. And we already used up 5 out of these 10, but I still have 5 more left here of this $5 stuff. So I'm going to use that. 5 at 5. Okay, now I need to account for 9. So far I've only accounted for 5. So 9 minus 5 is 4. I need 4 more. So I drop down here to this final purchase, and I'm going to take the final 4 at $6. Okay, so here's our 5 at $5 and our 4 at $6. We add our units up, make sure they equal 9. We sold 9 units. We got to account for 9 units on the 25th. Okay, so we got that down. So now we can multiply out. 5 times 5 is 25. 4 times 6 is 24. We add those two together, $49. That's our cost of goods sold for that day, for November 25th. So we would do a journal entry where we would debit the cost of goods sold for $49, credit inventory for $49. Now we can see exactly what our balance is Okay, we have a debit footing of 134, a credit footing of 86. Big number minus the small number, put it on the side of the big number, is 48. That's our balance of inventory. The 8 units that's still left in the ending inventory is $48. Okay, and our cost of goods sold account, expense account, is $86. Okay, here's where we calculated out the ending inventory separately to confirm that what it was in our inventory T account is correct. We have our cost of goods available, 134, minus our cost of goods sold for the whole month, which was 86, and that gives us the ending inventory of 48. And we have on our inventory ledger that we have 48 is our ending balance. So we have confirmed that that is correct. We also need to take a look at our gross profit. This is a very important number to management and to investors and creditors. And so this formula for gross profit, which is also known as gross margin, is net sales minus the cost of goods sold. You have to have that formula memorized as well as the cost of goods sold formula. Okay, so the net sales, we had sold for the whole month 17 units at $10 a piece. So we should have $170 in our sales account, should be a credit balance in our sales account, which is our revenue. Okay, we're going to subtract that, the cost of those 17 items that we're assuming is the cost of the 17 items. And that is our cost of goods sold account, which was $86. We subtract that and we get what is known as gross profit on those 17 items, which is $84. This entire formula goes on the income statement. And so we will have the net sales minus the cost of goods sold is gross profit. And then we'll go on down from there and we will list out all the other expenses, wages expense, rent expense, etc., and come down to net income. All right, so now we're going to take a look at calculating out the inventory and the cost of goods sold if we were on the LIFO system. And of course, the LIFO system means last in, first out. So the last, most recent purchases are the ones we're assuming are being sold. Now here's our data set again. This is the same data set. We started out with 3 units at 4. We purchased 10 units at 5. We sold 8 units at $10 on the 10th. On the 15th, we purchased 12 more units at $6. And on the 25th, we sold 9 units at $10. Now, we need to figure out how much is the cost of goods sold and the ending inventory if we were on the LIFO system. So again, if we happen to have a data set like we do, we're going to go ahead and multiply out the beginning inventory and the purchases, add those up. That gives us the cost of goods available, which of course is still $134. We're going to add up the units. We still have 25 units available. 17 of them were sold, meaning we have 8 left over. And we need to figure out how much of the 134 goes to the 17 that were sold, how much goes to the 8 that were in the ending inventory. Now here with LIFO, the last ones purchased, the most recent items are the first sold. But we have to use the last ones purchased that we know about. So on the 10th, we sold 8 units. So if we go back, on the 10th, we sold 8 units. So the last purchase that we know about is this one on the 5th. Okay, this down here is the last purchase of the month where we bought 12 at $6 on the 15th. That's the last purchase of the month. However, when we're standing there at the cash register on the 10th, we don't know what's going to happen in the future. We have to use the last purchase that we know about at that time, which is this one, 10 at $5. Out of these 10, we sold 8 of them. Okay, so we're going to take all of the 8 out of these 10, and they were $5 a piece. So 8 units at $5 a piece, 8 times 5 is $40. That's our cost of goods sold for November 10th. If we do our journal entry, we still have the sale part on the 10th, where we debit accounts receivable or cash and credit sales for the $80. That's 8 units times $10 a piece that we sold to the customer. Then we had to figure out our assumed cost, and we figured that out as being $40 using LIFO. Okay, so we're going to debit cost of goods sold and credit inventory for that $40. Here's our T accounts. Again, the debit side's exactly the same. Our beginning balance plus our purchases, $50 we purchased, $72 we purchased. That totals up to our cost of goods available for sale, which is our debit footing, $134. Then on our credit side is the cost of the inventory that went out of the store, the cost of the inventory we sold. And so here's where we debited cost of goods sold for $40, and we credited inventory for the $40 on the 10th. On the 25th, we sold 9 units. Okay, we sold 9 units. We have to go to the last purchase that we know about. Now, notice we're not going to go back up here and say, oh, we still got 2 left out of this because we used 8 of them for this first sale, but we still got 2 left of this $5. We still got these 3 left. No, we're not concerned with that. We're going to go directly to the most recent purchase, which is this one, and say, okay, I'm taking the whole 9 out of those 12 at $6. So here we took the 9 units at $6. 9 times 6 is 54. So that's our cost of goods sold for November 25th. So we would do our journal entry. We would debit cost of goods sold for 54 and credit inventory for 54. Now we can count up. Our debit footing is 134. Credit footing is 94. Big number minus the small number is, and put it on the side of the big number, is our debit balance for inventory. Okay, and so we're saying that the 8 items in inventory that are still left are $40, and the 17 units that we sold are $94. Okay, for ending inventory and gross profit, we take the cost of goods available, 134, minus the cost of goods sold of 94. The assumed cost of goods sold gives us the assumed ending inventory of 40. And we can go back and confirm that. Yes, my books say that my inventory is 40. And we can also look at gross profit. Our gross profit formula is net sales minus the cost of goods sold. We had 17 items we sold at $10 a piece, so that's $170 sitting in the sales account. We subtract out our assumed cost of goods sold for the whole month was 94. 170 minus 94 is $76 of assumed gross profit. Okay, now notice that the gross profit on FIFO was $84. Now my wages and my rent expense and all those other expenses that are going to get subtracted from gross profit to get down to net income, well, those wages and rents, they're the same regardless of what inventory system I'm on. So once I subtract, I have $84 of gross profit. If let's say I have $60 of other expenses and I subtract those, I'm going to have $24 of net income if I'm on FIFO. Now here I have $76 of gross profit on the same 17 items that I sold. Now if I have $60 of other expenses that I'm going to subtract from that gross profit, I will only have $16 of net income if I were on the LIFO system. I would be showing $24 of net income if I were on the FIFO system. And this is very typical that the FIFO system will typically show you a higher net income. So why do most of the big retailers want to be on the LIFO system? Since it shows a lower net income on their financial statements. Well, the big reason is because the IRS wants you to use the same system on the tax return. And so it can save those big retailers millions of dollars in taxes to be on the LIFO system. So even though they have to show a lower net income, they stick with the LIFO system. This is just mentioning about average cost in Accounting 101. You're not going to be responsible for how to do, I mean, you need to know what it is, but you don't need to know how to do it. If you want to go to the original PowerPoint that this YouTube video is on, then you can do that. And I have all the various slides on that PowerPoint. It goes through the average cost system if you would like to know how to do that. There will not be any problems on the test. There might be some general information questions about the average cost system, but there won't be anything where you have to calculate it out.